We are joined from Fort Worth, Texas by the president of AMR, American's parent company. He is Tom Horton. Tom, great to have you here with us. So first of all, after a strategy of basically staying with one manufacturer, why the split?
Well, Carol, this is a big transformational deal for our company, and it was just so big that we concluded that no one manufacturer could fulfill our needs in the time frame that we had here. So we want to go very fast with replacement of our fleet, and so we asked each manufacturer for a proposal, a very big proposal, and when we saw how powerful each of them was, we decided to do both. So it's not really a split deal, it's a both deal.
But Tom, you've had a strategy of staying with one manufacturer, and it's been a pretty smart strategy by some measures in terms of keeping down costs, scheduling and training by staying with one manufacturer. Tell me, what did Airbus, though, offer up that was so compelling here to do this?
Well, Boeing has been a great partner of ours, and their products are terrific, and so we're a very happy customer of Boeing. And of course, part of this deal is a very, very large order with the Boeing company. But we concluded that we really needed both manufacturers to participate in what we're trying to accomplish here. And so that was really the genesis of the deal. And quite frankly, the deals they brought us were extraordinary in terms of pricing and financing, and the economics of replacing our airplanes at $100 a barrel oil is really really very compelling. So we decided to take both deals and get on with it.
So Tom, in terms of going into the order, your thinking about this from day one was to split this.
Our thinking evolved over the course of the process as we looked at the two proposals and saw how good they were, how much financing was brought to bear. We concluded that the best course of action here was to do both deals. And to your question earlier, our thinking around the fleet is, today we operate 4 fleet types in our domestic network, the MD-80, 737, 757, and 767-200. In the future, we'll operate 2 families, the 737 family for Boeing and the A320 family for Airbus. So it's really going to be a more simple fleet. And within those families, you have commonality of cockpit and training and maintenance and spare parts and all of that. So we think this is really about streamlining our fleet and making it much more modern and fuel efficient.
Hey, Tom, if I may, just quickly, we've got about a minute left here, just switching gears. You guys also did release earnings. You actually posted a loss, a bigger loss than what the street was expecting. How come?
Really, oil prices is the headline there. We spent over $500 million more for fuel this year than last year, driven by prices. And so that's been a big challenge for us in the entire industry.
And one other thing that came out in your release, and this was about American Eagle specifically, you talked about your plans to definitely spin this off. Some are wondering about the timing of this, saying that Eagle doesn't have attractive assets, and it's kind of a horrible time to make this decision. Tell me why you think they're wrong.
Those plans have been long in the making, and it's really all about ensuring that American Airlines will have access to cost-competitive feed for our mainline airline, and giving Eagle the opportunity to go out there and compete for other business in the marketplace. So it's really more of a strategic decision for the long term.
All right, we're going to leave it on that note. Tom, thank you so much. AMR President Tom Horton joining us on In the Loop.